This is Invested in Climate with Jason Rissman. I see climate as the world's biggest, most diverse, most important movement in human history. Millions of people dedicate themselves every day to protecting the planet. This podcast shares conversations with advocates, entrepreneurs, investors, policy experts, and anyone else that can push our thinking about what's possible and what needs to happen to address climate change. If you have ideas for episodes or feedback, get in touch on LinkedIn. If you enjoy the show, please leave a rating on Apple or Spotify. I'm currently building a new venture. It's related to storytelling and how we engage all sorts of folks in meaningful climate action. If you have expertise in this area, big ideas, or examples of something that's really working, get in touch. Thanks for listening and for doing whatever it is you're doing to support climate progress. Okay, let's get started.
So the bottom line is, yes, AI is reshaping the grid and everything tied to it. Yes, it's forcing a rethinking of the electric power system that we haven't seen before. And yes, renewables plus storage and gas as a firming component are the single cheapest way to deliver 5 nines to data centers. But political friction is certainly impeding the basic economics of the market.
Hi, everyone. Whether or not we want to acknowledge it, we're in a new era of climate investing. Unprecedented uncertainty, federal policy upheaval in the United States, repeated energy shocks from wars, inflation, high interest rates, a persisting liquidity crunch, the AI data center boom. Much has happened. The game has changed, and investors are thinking very differently about climate than they did just a few years ago. 3 expert climate finance advisors who have worked in climate finance for decades set out to understand what has changed in climate investing. Dan Ferger, Will Coleman, and Bill Tarr are highly respected thought leaders and strategic advisors working with large family offices, foundations, and prominent climate investors. They teamed up and interviewed over 150 investors and experts to develop the Climate Capital Reset Project, a detailed account of the new thinking defining this new era of climate investing. We spoke about the trends reshaping climate finance today, emerging dynamics, recommendations for capital allocators, considerations for philanthropists, and much, much more. Dan, Will, and Bill's report will likely be one of the most influential pieces written on climate finance this year. It's already the basis for closed-door consultations and convenings with top investors. And our conversation shed incredible light on the new paradigms already driving climate finance today. Much to learn in this one. Enjoy. Dan, Bill, Will, welcome to Invested in Climate. Great to see the 3 of you today.
Good to be here.
No, thank you.
Great to see you.
Well, I've met you all in separate contexts, but it's great to be with you around a massive collaborative effort that you've undertaken, the Climate Capital Reset Project. Before we dive in, and there's a lot to cover, let's very briefly learn about each of you and the roles that you play in the climate finance ecosystem. Bill, why don't you kick us off?
Great. Good to be with you all. And thank you, Jason, for having us. I've spent 25 years as an investor and strategic advisor and a coach of sorts to founders of climate and healthcare companies and funds, primarily in the private markets, helping them typically get off the ground, find early team members, early capital, and early kind of customers or investments. I've also spent a fair amount of time working with family offices and foundations that tend to be early innovative adopters in these arenas and are looking to drive kind of transformative scale and systems change into this world, into these 2 sectors in particular. I've come together with Will and Dan on a number of instances as close friends and collaborators, and had always kind of hoped to kind of bring their backgrounds together with mine on something, and it seemed like a timely occasion to do so.
Great. Will, over to you.
Yeah, great. Thanks for having us. I've spent the last, similar to Bill, 25 years in the climate space, doing a host of different things, but predominantly focused on early stage innovation through working with venture funds that helped launch the clean tech practice with More David Out Ventures back in the early 2000s, and then started something called On-Ramp Capital to help corporates engage and do more innovation in the space. Ran a company for a while, and then more recently helped launch Regen Ventures out of Australia, and come at this largely from having seen that evolution over a number of different cycles. And so, as Bill mentioned, we felt it was a pretty important moment and to try and take stock of what was actually happening and help others do the same.
Great. Thank you, Will. Dan, take us home.
So you've got three guys, each of whom has spent 25 years. We're 75 total in climate investing, climate finance. I started out my journey at COP6 as a college student protesting the Clinton-Gore administration, if you can believe it, for not being ambitious enough on climate change. This is, in 2000. Here we are now, it's COP31 this year, so 25 years. I started my career really as a lawyer, though, doing project finance, renewable energy projects primarily, as well as carbon market back when that was a bigger and newer thing than it is these days. And then I went to philanthropy. I joined Michael Bloomberg's foundation, Bloomberg Philanthropies, before the Paris Agreement and led the sustainable finance and climate programs there for about a half a decade. And since leaving, I've been running this firm, Great Circle, that works with families, foundations, impact investors, asset owners on climate, nature, transition topics. So yeah, you're talking to three guys who've got a lot of complementary skills and networks in this space.
Well, that the three of you worked together to conduct over 150 interviews and develop what is now a over 70-page report suggests that there was a big, important question that was keeping you up at night. Bill, why don't you get us started and help us set the stage and explain the genesis of the Climate Capital Reset Project and what's at stake? Why is this project so important?
Great. Well, thank you. So the project began kind of in late Q1, early Q2, 2025. Obviously, it was a moment of significant upheaval for both the market as a whole, as well as the climate-focused capital. There was just increasing kind of unprecedented market and geopolitical uncertainty. Some of those characteristics resembled past corrections we had experienced firsthand, which had particularly persistent consequences in some cases for climate tech and climate capital markets, along with many new ones that did not bode well. It felt like a particularly open time as well, with rare levels of humility and curiosity in both the private markets and philanthropy to do a more kind of candid assessment and seek outside points of view, which opened up the door to do this, to really kind of inquire about what has held back more innovations from scaling across kind of energy, food and ag, water, built environment, et cetera. To do this, we felt it was necessary to kind of question all of our old assumptions and stress test them against this new and emerging kind of set of conditions with the world's most sophisticated and active investors, executives, policymakers, philanthropic leaders, et cetera. Many of whom we knew well, or because of just the worlds that we had traveled in for over 25 years, could reach through trusted mutual friends and facilitate very confidential, behind closed doors conversations to really try to surface whisper truths and things that were unsaid that we could bring into the public discourse. We made a real effort to draw from the leading research of our deeply respected friends and thought partners over many years, who we've carefully credited throughout the paper and in the acknowledgments. And we really wanted to just surface the unvarnished perspectives that we felt like investors and allocators could use to start finding conviction earlier than they maybe otherwise would, and take advantage of dislocations, identify critical gaps in capital stack, supply chains, value chains that we could try and fill more quickly and unlock more scale more quickly. So one of the things we're trying to do also is just build ecosystem connections and trust between collaborations between capital and company builders and GPs through this as well, and which we will build on over time. And it's going to take deep partnership and trust to accomplish what we want to on the other side of some of these likely dislocations and disruptions in the market.
Thanks, Bill. Dan, your report points to 10 obvious trends, obvious in quotes, reshaping climate capital. Each one of these 10 are interesting, and they actually each could be a full episode. At the very top of the list is unprecedented market uncertainty driven by geopolitics, US federal policy, AI disruption, inflation, et cetera, et cetera. Is uncertainty simply the new norm? And what needs to happen for climate investing to be more resilient amidst continued uncertainty?
It's the right question to ask. And I'll just point out the obvious, which is we started this project a year ago almost, around the time that the Independence Day tariffs were first announced. I put that in scare quotes as I say it. There were a set of real market dynamics that were uncertain around climate and climate investing in April, May, and June of last year as we got this project up and running. That has not abated. And so as we were putting this project to bed, and certainly in the past couple of weeks as we've been socializing it with stakeholders, the war in the Gulf and the energy market disruptions that are ensuing, have just re-scrambled the card deck yet again. The thing that we're pleasantly surprised about, I guess, if you can think about a silver lining, given what's going on in the world, is that a lot of what we surfaced over the course of a year of talking to people is still directly apropos of the conversations that are happening right now. It's not a stale report that has a bunch of findings that aren't relevant to anyone, given the new normal of energy markets globally. I guess I would say, Jason, just to answer your question directly, anyone who wants to navigate towards a long-term goal like deep decarbonization and resilience around climate while dealing with the disruptions that are happening week to week, sometimes minute to minute in the markets, is familiar with this, Mark Carney popularized it, the tragedy of the horizon, right? I think what we need to do as a community, people allocating capital into climate purposefully, which is how we describe kind of climate capital in the report, is understand how to navigate through some of the near and medium term with a long-term goal in mind. And that's very much, I think, what's ideally going to come out of this report is some insights and some real optimal pathways for allocators to do that.
Thanks, Dan. Will, over to you. One of the other obvious trends is the AI data center boom. On the surface, it's a huge opportunity for renewables. How do you see AI's energy needs impacting decarbonization?
Yeah, this has been a hotly debated topic. Even over the course of the project, the view on renewables has changed largely thanks to AI. And so when we started, renewables were 92% of all new energy capacity deployed globally in 2024. And then with the new administration, all the headlines, everyone said, well, renewables are dead and it's all about nuclear and geothermal. And then it was, yes, renewables are the single cheapest way to supply power for the demand of AI. And it looked like a massive boon. And then, of course, the pendulum swung again. And the question was speed to power, and permitting frictions were slowing down renewables. So therefore, we were going to see a lot of gas, and so et cetera, et cetera. And so we've seen this pendulum swing back and forth over the course of the last 12 months. And then you layer on Iran now. And what we've seen is that the amount of demand is obviously continuing to go through the roof. The pipelines in a lot of these regions are full of renewables. So there's a boon there. There's long lead times on gas combined cycle turbines, but they're dropping in Rembarkers and all sorts of other, small gen sets in order to offset that. But we've seen the pendulum swing back because of the friction. And so we've seen more recently about 50% of all new deployments are gas or some other form of fossil fuel. So the bottom line is, yes, AI is reshaping the grid and everything tied to it. Yes, it's forcing a rethinking of the electric power system that we haven't seen before. And yes, renewables plus storage and gas as a firming component are the single cheapest way to deliver 5 nines to data centers. But political friction is certainly impeding the basic economics of the market. And every megawatt hour of capacity that gets built as gas or even diesel gensets likely has a long tail. So on net, no, AI is not solving the climate challenge, even if it is a boon for a number of renewable energy companies.
Thanks, Will. Bill, another trend that caught my eye is the liquidity crunch. Do you expect this problem to persist? And if so, how will that impact returns and interest in climate investing?
Yes, well, this is something that's on top of everyone's mind and something we've lived through in other cycles. And I think this one is going to be particularly significant, but that creates opportunity. So I think one of the things we talk about in the paper is kind of liquidity crunch, liquidity premium, and capital scarcity. So you kind of look at those realities, and there's just an absence of secondaries, and exits has created a liquidity. Obviously, the public market challenges. If you're not an AI company or in the AI themes, allocators right now, the premium on liquidity is so significant at a time when really we need long-term kind of committed capital that's properly structured. So there are just some inherent structural challenges around what climate technologies and infrastructure requires that need to be kind of fundamentally addressed. So we talk a lot about, trying to unpack the missing middle. A lot of people come at that from a lot of different angles, and we try to define it more clearly along its nuanced kind of lines. So there are multiple structural gaps that exist in kind of various stages. Obviously, there's folk and demonstration, there's early commercial deployment, there's sub-market return infrastructure, there's late-stage IPO. But this really fundamental conflict between equity, obviously, which requires outsized returns and ongoing kind of capital and throughput in terms of demand of the markets, and then debt, which requires the bankability piece. So one of the things the allocators and large investors are talking about increasingly, we were surprised how little they had in their portfolio other than the big names or with it had real significant experience in roll-ups, turnarounds, verticalization strategies, consolidation strategies. So we think that's a gap that's glaring that needs to be filled. And there's a huge opportunity to take advantage of those dislocations with the right kind of teams and the right domain expertise. So that is something that we're spending more and more time looking for and trying to think about how do we bring together some of the key market actors to create structures that can take advantage of the coming dislocations with new aligned structures for kind of long-term positive outcomes.
Thanks, Bill. Guys, I picked 3 of the obvious trends that stood out to me. Is there any others that you feel just need to be mentioned?
I think the narrative and messaging pieces, which relate obviously to the political environment we're in, was something we heard really across the board from everyone. There are people we talk to who are former policymakers. There are people we talk to who are large family offices allocating capital sophisticatedly into the market. There were climate tech or non-climate tech startup founders who had lots to say about the label on the tin, so to speak, and whether that's net zero or ESG or climate just as a word versus things like resilience or energy or American energy dominance, whatever it is. I think the people who are most sophisticated in this moment are less concerned with the tagging, the labeling, the disclosing, the reporting, and more concerned with the underlying activities that we all want to see happen. More resilient grids, more abundant, cheap, affordable power that's clean, that's good for people, et cetera. And that kind of, let's call it messaging and narrative confusion, given the past decade of really well-established practice and norms and frameworks and standards and taxonomies and all the rest, that came through loud and clear that we need some new terminology. And I think lots of people are working on it, but it's certainly not a settled, we don't have the playbook for the next 10 years of climate investing and all the words on the page, so to speak, yet. And that was something I thought was really important to just name in the moment we're in.
Dan, I appreciate that, especially since in my 25 plus years of working in areas related to climate, storytelling and messaging has been a core focus. And as you guys know, I'm working on it in a handful of ways right now. But I'm curious, even if there isn't a playbook, directionally, was there any sort of guidance or ideas around new ways that we need to be talking about and messaging climate and climate investing?
Yeah, I mean, I think one piece of this is whether it's climate investing. So there are certainly things that are specifically addressing climate that are carbon related or what have you that only exist because they're solving a climate problem. And those are definitely climate investments. But there's an enormous number of things that have been invested in as through the climate lens, which are simply just addressing a very specific problem in a very specific sector. And I think what Dan was getting at is super important because there's also the need to decouple those things to some degree. So yes, there's a need to rethink what the motives are and how to drive the message the right way. And one of the things we saw in this set of conversations was that long-standing principal agent problem, where you had a bucket, climate, which is in disfavor because of the politics, and therefore there was a pushback on investing in it. It was perceived as risk. And so it's one thing to have an allocator who is leaning in on climate and sees it as a mission. It's another if you have an allocator who's careful and wants to avoid risk. And so they see this more as a challenge. And I think the opportunity is to go out there and both from an allocated perspective, from a principal perspective, push those investment managers to think differently about these sectors, but also for the GPs and the companies to be realigning around the sectors that they are changing. And they're producing fundamental change as evidenced by the fact that, if you go and you look at something like, Intersect Power, which we can talk about later, but these are companies that are changing their stripes because they are not just climate companies. They're actually solving a true immediate problem.
Thanks, Will. Let me know when I need to change the name of this podcast. It's been suggested that instead of invested in climate, it should be invested in everything. But yes, we might need to rebrand. Guys, the report also includes emerging dynamics, recommendations for capital allocators, and considerations for philanthropists. Cutting across all of these is what you describe as the most common theme. That is that now is a time for ruthless pragmatism. Examples of this that stood out to me were a clear skepticism of continuity efforts that are bridges to nowhere, a need to reinvent the default 10-year fund structure, and to simplify impact criteria. In many ways, the push for ruthless pragmatism is a call for, well, a paradigm shift from having the space of trying lots of approaches to being more rigorous and more methodical to growing up in a way. Bill, tell us more about what being ruthlessly pragmatic really means and the most important shift you see towards realizing this need.
I'm going to hand this over to Will because he really coined it, and I'm going to let him take it. I will just say this. I think it's a healthy, one of the reasons we called this Project Reset is we really did want to meet this moment in a really pragmatic way and get past. There's a lot of well-intended innovation and creativity that's been going on for decades now. It has been subscale, I think, for a pretty consistent reason in many cases, in that there has just not been a full appreciation for what it does take to get from catalytic capital to private markets. And how do we get philanthropy and private markets speaking in a language and having a deeper understanding of each other's requirements and governance and investment committee dynamics. So I think trying to create a bit of a translation layer that really focuses in on what is required to get things done at scale, and how do we then design from the ground up, recognizing those requirements and needs to get to more consistent outcomes. But I'll hand things off to Will on that regard.
Yeah, I mean, the concept came out of any venture fund will hit moments where the market goes down and they are looking at how to protect their investments. And there's an evaluation that goes on around bridging those investments. And you look at it in a space like climate, and I think that also gets commingled with what companies can have the biggest impact. And you also have philanthropy playing a role, and you have blended finance, and you have all sorts of other incentives that are there. And I think sometimes you end up sustaining the things that never had a market in the first place, or were subscale, or really don't have a viable opportunity on the back end in the absence of some form of support, subsidy, et cetera. And so I think part of what we were getting at was it's complicated in this space, and how do you decouple some of those things and just really put on a very disciplined lens and think about how do you prioritize some of these investments? How do you, and it should be through the lens that you're operating from. So if you're looking at it from a private investment perspective, that's very different than if you're looking at it from a philanthropy perspective. And so that's why you saw language like, avoid bridges to nowhere, and thinking about how to really be strategic and precise and targeted with the dollars to unlock the sustainability of some of these companies to get through a period of uncertainty was critical. But the other piece of it is we think there's massive opportunity in the space, and you shouldn't shy away from it. Distress creates opportunity. And we think that's, sometimes when you're in it for a mission, you don't quite see it that way. And I think we feel it's important, based on the conversations we had, and a lot of people were saying this, to have additional capital come into the space because it sees that opportunity. And distress presents a really interesting moment where you can actually do all sorts of things, including, consolidate into much larger entities that ultimately are the biggest companies that have the largest impact over the longest term. So I think that's, those are the kinds of things that we're hoping people will think about.
Let's double click on this. The idea of double checking continuity efforts or building bridges to nowhere is maybe one level of ruthless pragmatism. Your report also recommends that capital allocators actually work to shape winners through consolidation. That sounds like a different level of pragmatism. And it's playing a pretty heavy hand, which might not only be unpopular for those being shaped, but also it's a role that requires a new mindset and new operating system for the allocators. Do you actually see examples of this happening?
Yeah, I mean, this is, as you said, this is another great example of being ruthlessly pragmatic. And the reality is that climate, among other sectors, went through a frothy moment. And there's a lot of companies that got funded that might be partial solutions or have valuations that got distorted, and they're creating overhangs. And the problem is that those overhangs can create binary outcomes. So part of what we're getting at here is how do you play on the amount of value and insight and progress that has been made inside of a lot of these companies and avoid that evaporating? We saw in the first sort of clean tech wave, there weren't entities out there that were playing that kind of role because they were risk off on the entire sector. And so you saw a value that had been created entirely evaporate. It wasn't like, the old fiber companies that built out tons of fiber went bankrupt and then all got consolidated into much larger entities that are now the backbone of what we do, right? It was a lot of these companies just disappeared. And so did the IP and the know-how and the talent. And so the opportunity here is that we have seen it happen in other industries. We've seen that it either happen in response to a downturn, or we've seen it happen in some cases just as a way of building from the ground up. I mean, one example is Lineage Logistics, which does cold chain storage, and they aggregated these companies together from the beginning to build a much larger entity, which is now the largest player in the sector. And I think that's kind of the key here. We've seen other examples where it's been more reactive to the downturn. And I think in those cases, are the early investors happy? No. Are some of the founders that are no longer there happy? No. But is it actually a healthy thing to do in the marketplace and good for the actual company? Yes. And can it produce massive outcomes over a longer period of time? Yes. I think the key is what we don't need is a group of vulture-like investors coming in, doing special situations, tear it apart and try and sell it for parts. That's not really the opportunity. The opportunity is to come in and see where there's really opportunity to integrate a set of things and create longer term growth. And I think that kind of value approach will be really interesting in the space because it is a long duration cycle ultimately that these companies are building against.
There is also, we'll talk more about this, I'm sure, but there's also the international versus domestic dynamic. I do think, last time around, there was a bunch of IP that was left for whether it was the vultures or the Chinese, other people, not US companies and US capital scale. And then here we are, right, with cheap solar and cheap batteries, all of which are manufactured in China. So there's this question of where is this stuff built that layers in on top of the IP, the capital, and the actual talent inside these companies that are stressed right now.
Great. Thanks, Dan. Dan, the report also describes blended finance as often being misused. Tell us more. You argue that while market rate investment opportunities are abundant, they're nowhere near sufficient. So how does the use of blended finance need to change to help fill that gap?
It's a great question. It's one a lot of people in philanthropy and broader conversations are grappling with right now. And just to kind of name it, there's no real consensus definition on what is blended finance. So what we mean in this document is concessional or non-purely commercial capital coming into investments that are meant to earn a return, right? There's plenty of philanthropy out there that is doing really important and good work and should continue to. There's also plenty of investors, earn a return. Between, there is this mushiness that Will talked about a few minutes ago around what are we actually doing with this capital and what are the goals of this capital in getting involved in a deal, in a company, in a round, in an investment vehicle. And, plenty of ink has been spilled about this, but just to point out the obvious, which is there's less concessional capital if you consider government dollars as well. The Inflation Reduction Act, both the tax incentives as well as the Greenhouse Gas Reduction Fund money is gone. USAID on the international side is gone, right? So there's less concessional capital broadly defined or blended finance available in the system for climate. And yet we're trying to do a bunch of things with companies and business models that require some of it, right? And so in that environment of constraint or limitation, we just, again, need to be ruthless and a bit more pointed about this additional marginal dollar of blended or concessional capital is here to de-risk this particular piece of the capital stack, and this is the job it's meant to do, right? Instead of an entire sector, an entire market, a category, for instance, I'm just going to pick on my friends in the carbon removal industry for a second. That industry presupposes a market signal long-term that may or may not be coming. And so throwing more good money after bad to try to prop up a bunch of startups in the carbon removal industry that, sure, Frontier exists and Microsoft is buying $800 a ton carbon removal credits, but without a policy signal and a long-term sort of market for this stuff, should we be throwing huge amounts of philanthropic capital into removals? We can debate that, right? People have different views. But just to be clear about what you're doing when you're deploying that capital, I think is one of the things we felt like was important to name. And there are a lot of these, Will said it, bridges to nowhere that happen because we have not been clear about exactly what the commercial versus concessional intent is in scaling a business or a business model. It's a longer conversation for sure. I have lots of friends in philanthropy and blended finance spaces that are smarter than me about exactly what these trade-offs are. But as a market, in terms of climate capital, we, I think, don't do ourselves any justice by being squishy in some of the definitions and some of the lanes that this capital operates in.
Dan, do you want to speak to maybe one or two examples that are working, that have learned and evolved? Maybe
yeah, I mean, not too many names, but the sponsor of this work, Builder's Vision, I think is quite sophisticated on this point. When you have a full range of tools in the toolkit, from pure grants to pure investment grade, commercial return-seeking capital and everything in between, I think they've been very clear and very public actually about where they see the role of different types of capital, whether it's a loan guarantee or, a PRI program related investment, or this is actually a market that we think can stand up on its own 2 feet, and we're going to invest our endowment, our commercial capital into that, right? Lots of investors in philanthropy, I think, are doing a very good job of this. It's just structurally, though, in the market writ large, we've been both benefiting from and also maybe being a little lazy around the winds at our backs that are no longer there, right? Around policy, market, new philanthropic donors coming into the space year on year between 2015 and 2025. Huge flowering of new sources of sub-market return capital that just aren't there anymore, or aren't there at the scale they were a couple of years ago, as you know.
Bill, let's go to you. With the US pulling back from climate investing, the report sees an opportunity for what's called geographic arbitrage. Can you share an example or two of industries and also geographies where you see the biggest opportunity for near-term investing to take advantage of this arbitrage?
Sure. I mean, it's complicated. It's a big world out there. We're by no means emerging market experts, but I would say, there's a couple of obvious things that we're seeing. Very sophisticated global allocators starting to look hard at and lean in on, which is, one obvious dynamic here is this kind of move to electrification. Think solar, EVs, storage, et cetera. Basically other tariffed goods from China that have come way down the cost curve that are now going into these emerging markets. You could think Africa right now has the solar capacity built of Florida. I mean, it's extremely open market. So cheap cells would be a huge boon for the development industry there. To some degree, one of the themes here is America's loss is the emerging markets gain for lower cost products. And with our demand coming off the table, that actually creates a price, downward pressure on price for a lot of this equipment. A growing number of promising and well-funded vertical food and agriculture strategies in the EU and India in particular. They kind of fit into the food security and onshoring categories. I think keep an eye out for insurance-based models that align kind of risk and return over a longer term horizon for nature-based solutions that could, and or resilience adaptation technologies that could enable potentially habitats and or, livable landscapes that would otherwise become uninsurable to keep them insurable for much longer. Similar to some of the things we're seeing in healthcare in terms of new models and how they use insurance to create long-term kind of alignment with all stakeholders. And then I think to what Dan was referring to is kind of what's this next evolution of the carbon markets. I think keep an eye on kind of the carbon markets protocol and others. We're moving towards potentially evolving this into where really we believe it, to some degree it belongs, which is on the balance sheet. And that combined with insurance, I think you can create potentially some financial alignment for longer term, larger scale opportunities in emerging markets. And then ironically, I think you might see things get tested and proven in the emerging markets and then come back into the developed markets more and more.
That's happening with obviously mobile money in East Africa, or even, things built on crypto rails in terms of processing in emerging markets. It's happening there first, and eventually it'll happen here.
Thanks, guys. Will, let's go to you. What about the role of big companies? Even when there was a lot of pressure to make and fulfill climate commitments, I was hearing about corporate reluctance to bet on new climate tech that was making it impossible, really, for a lot of new companies to achieve scale. how important are corporations in driving climate capital flows, and what role should they be playing today?
Yeah, I mean, they've always been important and they've always been reluctant. That only gets worse when we are in a risk-off cycle. But if we're counting on corporates to swoop in and save the day on innovation, then I think we're going to be waiting a long time. The reality is that they are fiduciaries, have shareholders, and they are navigating constantly how to move their core businesses forward, how to compete, and how to minimize risk. And I think where we've seen a desire for them to lean in, particularly around first-of-a-kind technologies, around early commitments, it's been hard because that's not in the DNA of the organizations. And so you have seen some do it. You've seen some get out ahead, particularly on some of the carbon pricing stuff where there were some early commitments. I think those had their own calculus behind them in terms of goodwill and branding, and there were other motivations there. But I also think that in general, most of these organizations are really doing it when they see an asymmetric advantage, or when they're trying to catch up, or when they are trying to mitigate some long-term risk. And in that case, it could have been, that they were worried about carbon regulation and pricing, et cetera. But we did see more recently, we saw Google swoop in and buy Intersect Power, which I mentioned earlier. And that was in large part because, both parties realized Intersect wasn't just a power developer. And it was, in fact, the linchpin of them being able to build out their DC business. And so, as these companies are converging in certain sectors and becoming less just maybe a renewables company, but more enabling of an entire sector, you see that need to sort of make commitments and step out and get ahead. But I don't think Google is coming in and funding folk projects in carbon anymore. But the reality is we need a market driver. We need, if we don't have market drivers, we need regulatory drivers. And that said, one of the more interesting things we did hear about is that some of the larger sort of MDBs, right, development banks, are out there playing a more tactical role in this dynamic. And so what they're seeing is the need to draw corporates in, and they're seeing some of the barriers for corporates to engage as off-takers in ways that are conducive to early stage projects. And they're trying to neutralize some of the risks that are the reason for that. So for instance, we spoke to one who's leaning in on performance guarantees, where you have things like grid instability. And the problem being that it's a relatively small piece of the project, so it doesn't take enormous dollars, but it's binary. It's how a project tips over if a project's not performant. And if there's grid instability and you don't meet those performance guarantees, then the economics don't work. And so, for that MDB, it's enabling of an entire sector and an entire region. And it's a relatively small pool of capital. So we're seeing, there are groups that are playing these more targeted roles in terms of unlocking that corporate capacity, because it is critical. And in the absence of regulatory pressure, you have to use some of these mechanisms in order to do that.
Thanks, Will. Dan, the war in the Middle East and the energy shock it's created is another clear example of the kind of uncertainty that you say is a major driving force in our markets and decision-making. What influence do you see the war having on decarbonization and climate investing?
I'm going to summarize a lot of people who are smarter than me on this topic. Podcasts, we're all listening to articles that have just been written in the past week or two on this topic. And I think there's the obvious, and then the sort of one level down or even two levels down, less obvious sort of second and third order effects of what's a crisis that probably is still in its early to middle phase. I think no one knows what's going to happen tomorrow, let alone next year, in terms of oil prices, obviously gas, a different market, traded differently. I was on the phone this morning with someone in Southeast Asia who's thinking about regional grid integration in ASEAN in a way that has never been done before. Obviously, we in the United States are familiar with PJM or ERCOT, the different, regional transmission organizations in the US that manage the grid. The Europeans have gone through a process of integrating their grid. That has not been done in Vietnam, in Singapore, in all of the countries in the region that are so dependent on gas, mostly Qatari gas being exported through the Persian Gulf. And that's a live conversation over there around maybe we need to get our act together and build a much more integrated grid that is much more capable of scaling solar in particular, but also offshore wind and storage in a way that's going to make us more resilient to these supply shocks, right? That's going to happen everywhere. That's happening in Europe. I am not the expert on international relations and what's going to happen in terms of the Emiratis versus the Saudis versus, the Europeans. And don't forget, there's another war in Europe, in Ukraine, that's still ongoing. I think at the end of the day, no one's fighting wars over the sun. And I think to the extent that solar plus storage is a long-term stable source of base load power combined with things like geothermal, I'm surprised we've gotten so far in the conversation and not talking about Fervo and a potential IPO in a couple months, whenever that's going to happen. There are huge new sources of non-fossil energy that have barely been deployed at scale in many parts of the world. Those parts of the world are the ones that are most reliant on a much more uncertain source of supply, if you think about both oil and gas, right, from the Gulf. So who knows? I don't want to sort of say like, let's make lemonade out of lemons or whatever, but there are all sorts of deep uncertainties about the future. And one thing we know for sure is that the sun's going to keep shining, right? So my sense is there's a lot of opportunity in this moment of instability. Of course, and I'll just say this, I used to work for Mike Bloomberg. I ran the programs trying to retire coal-fired power plants around the world. There's going to be a lot more coal burns this year than projections, right? So this is not a good news story and an unvarnished, like, the war means more renewables, period. It also means more lignite in Germany and Poland. It means more children getting asthma and getting sick and dying, old people dying because of coal. It means more global warming, probably. It's not a good thing that we're at war, and it's not good for renewables, period. But I think there's a lot of resilience-oriented and national security-oriented, this gets into the framing conversation, investments that will be made that will have the effect of locking in low-carbon energy for the next decades. That is, that people are making those decisions right now because of what's happening in the Gulf.
Yeah, I think that's really well said. And I think that one of the big fundamental takeaways from this work is talking to people who are sitting in seats with a tremendous amount of responsibility for allocation and looking at all these global drivers is just the not only uncertainty, but just the level of instability geopolitically and what that means regionally. And these supply shocks and other shocks that are coming, this age of resiliency feels increasingly like the kind of the motto of sorts right now. And that's leading allocators increasingly to think about what are these critical path dependencies to basically being able to own and operate and control their capital stack, supply value chains in new ways. They just can't get away with the levels of dependency that they could in the past because there was just deeper trust and there was deeper interdependence, healthy interdependence in these markets. And it feels like that has eroded to the point now, it doesn't feel, it clearly has eroded to the point now where folks have to go hyper-local and hyper-resilient. And that could actually lead to a lot of really interesting new kind of stories around regenerative and sustainable outcomes, ironically, but it could create, through the ashes, I think you're going to see a lot of very interesting phoenixes emerge that could be incredibly resilient and sustainable by nature and by design, because they have to be, defensible.
Thanks, guys. Really interesting stuff and obviously sensitive and complicated topic. So I appreciate you weighing in on it. Before we wrap, let's give you each a chance to elevate a new idea that you think deserves more attention. In your interviews, you heard experts talk about new investment models, new ways of talking about climate, and new policy initiatives. What stood out to you as holding the most promise? Bill, why don't you keep going and get us started?
Gosh, there's so many places to go with this. I mean, I think first and foremost, where one of the drivers for me to do this work was, I've had the pleasure of working with a company called Devoted Health, which is just starting to become more public with what it does. But what essentially they started with a new insurance company for healthcare. And instead of fee for service, which is really the cardinal sin in healthcare, it's fee for value. And so that's actually fun, essentially providing incentives for prevention and holistic healthcare, which is really the only way we're going to be able to bring down costs enough and quality of care up enough to not go bankrupt with the growing population of seniors and chronic disease, which essentially is going to bankrupt most developed countries in the next 10 to 20 years if we don't figure out how to project preventative holistic healthcare into the population to bring down those costs and improve quality of care. So by essentially creating a new insurance structure and then a healthcare provider and all the technology. It's an alternative healthcare universe that can operate independently and not be pulled into the perverse incentives of the existing system. They have been able to scale in ways that no one has in healthcare. And I think that bodes really well. If you can do that in a very entangled, complicated, perverse incentives structure of healthcare in the US and more broadly, eventually, we hope, I think it bodes well for what could be possible in energy, transportation, the built environment. I think, so I'm very intrigued by how do we create new insurance companies or models that properly incentivize kind of resilience that can then lead to essentially taking a lot of risk and align outcomes with incentives in terms of compensation with the right stakeholders that are required to transform industries. And I think the other thing is just, it's attracting the kind of talent to transform these industries. And I think we're getting beyond now climate and sustainability, and we're really talking about fundamental industry transformation that's required to be sustainable and to compete. And so I think right now with AI and with these things, you're seeing just so much more innovation and experimentation that can be done at such a low cost barrier that I think that bodes well. That I think we're going to see some new breakthroughs in the months and years to come that can attract capital much more quickly than they maybe have in the past because of dynamics of the way they're using technology and the way they're diagnosing problems much more quickly and then designing solutions for that diagnosis.
Thanks, Bill. Will, over to you. Anything stand out to you?
Yeah, several things. I'll try and keep it to one. Yes, verticalization. I think there's really interesting opportunities there. Yes, consolidation. There's all sorts of things that in the near term are being triggered by this moment. My brain kind of goes old school, which is I think we have grown across the entire economy really addicted to this venture capital, private equity model. And we've sort of come to believe, particularly because it consumes all the headlines with the companies that are born of it, that it's the way to build big, massive companies. But if you look at the history of our economy, a lot of the biggest companies over time, or at least the sort of largest, if you look at the largest wealth holders, those folks have built long duration, asset heavy businesses over long periods of time. And I actually really think there's a huge opportunity, particularly in the space where we're talking about not refactoring the digital divide or some new whiz-bang technology that's on the bleeding edge. We're talking about refactoring 95% of the economy. I think there's a huge opportunity to go build these large consolidated companies over time. But I think you got to think in long duration. And so that's something you also have to think through with large capital, because it's not something that just happens. That's the main one. And then the only other thing I would say is just on the flip side, we really do need to start talking about climate differently. And I think we need to start talking about it differently with different audiences. We need to get into the needs. We need to start talking about the real realities of what's coming, because the pain is only going to get more acute. And the reality is that this is a persistent trend that is not going away. It's not going to abate. I think what we're going to see is more near-term disruptions because of things like insurance and dislocation of populations, all sorts of things that will come home to roost. And I think the smart allocators are leaning into that. But I think as a general idea or sort of new approach, I think philanthropy and those who are doing advocacy need to really think about how we are positioning climate.
Thank you, Will. Dan, over to you.
I'll pick up where Will just left off and say, I think the window for reset is open, but it's not open forever, right? And I think we had a 2015 to 2025 framework that was complicated, contested, imperfect, but well understood by capital markets participants, the policymaking community, the Biden administration, et cetera, as well as philanthropy and the green groups, climate advocates, et cetera. It was contested and hard won, but it did do its job in certain ways for the past decade. We don't have that plan in place for the next decade. And I think some of what Will was just saying is right around the fact that we have to do this work now. The midterm elections are happening in a couple of months. Then it's going to be people fighting over what to play for in federal policy and geopolitics in 2028 with the election coming up. I think not that all of this is political, but I think the sort of capital markets leadership that we spoke to for this project, the people who are deploying real dollars into real solutions, need to not only have a seat at that table, but ideally sit at the head of that table, meaning the people doing the work to build the industries of the future need to define for the rest of us, the world that is, nonprofits kind of writing white papers and stuff, what it's all about. And I think it's about security. It's about affordability. It's about resilience. It's about sustainability. I don't quite know what the acronym is that we could extract from that and have it be sort of a talking point, but that's going to have to come. And I think it's going to have to come from this set of people, meaning startups, founders, investors, allocators, market leaders. That's the work for all of us, I think, in the coming months.
Well, let's talk about what's coming next for you guys and for the Climate Capital Reset Project. This has been a really interesting, fascinating, exciting conversation, and I think an important one. What's next for this project?
Well, we're going to be convening around some of the large events over the course of the year, smaller groups of sophisticated capital providers, investors, company builders, and GPs around specific themes, sectors, and what could some of these verticalized strategies look like? Really kind of think about how we could co-design and co-develop them, because it really is going to take a village, so to speak. It's going to take deep partnership to unpack these dynamics, get to conviction, and to be able to be willing and able to play a longer game to build the kind of resilient models that can absorb shocks and come out the other side and take advantage of those dislocations. I mean, I think that is the theme of the day, and we can all get smarter together. And that's been one of the challenges of this space, is just too many silos, too much fragmentation, too many semantics. And let's try to get to some unifying themes, strategies to really mobilize the movement necessary of capital and talent to get there.
Bill, Dan, Will, thank you so much for your time today and for your work on this report. All the best of luck.
Thanks so much, Jason.
Thank you.
Thanks for joining us for this episode of Invested in Climate. Please remember to rate us on Apple, Spotify, or Google. Find show notes, sign up for updates, get in touch, and visualize your climate action at investedinclimate.com. This podcast is for informational and entertainment purposes only and does not constitute financial, accounting, or legal advice. Thanks again.